Welcome to this explainer. Today we're diving straight into what is literally the biggest financial mystery of the week, the massive, and I mean completely unexpected turnaround of the Swiss franc. You know, the foreign exchange market recently displayed a very clear differentiation pattern, but tucked right inside that data was a shift that caught almost every major analyst totally off guard. If you were tracking the numbers early in the week, you saw one story, but by the time Friday rolled around, a completely different reality had taken hold. We are going to break down exactly how this happened step by step.
Okay, let's set the scene here with an incredibly low strength score of just 26 points. To give you some context on this, earlier in the week, the US dollar was leading the pack with a solid strength value of 75. Meanwhile, the Swiss franc, it was sitting dead last, right at the bottom of the market on Tuesday. It was firmly in the weakest position possible, lagging behind along with poorly performing currencies like the Canadian dollar, the New Zealand dollar, and the euro. Honestly, if you saw this 26-point score on Tuesday, you'd have reasonably assumed the franc was completely out of the game for the week.
But then, we see this, a staggering 41-point explosion over literally just 3 days, which absolutely changes everything. The franc catapulted from a dismal 26 points to a commanding 67 points. It transformed from the market's biggest loser into a dominant powerhouse, sitting right behind the US dollar as the second strongest currency overall. It staged a shocking reversal that brought some intense volatility to the market. But, as we know, a 41-point jump in less than 72 hours doesn't just happen by magic, right? There's always a catalyst, or in this case, a few of them.
Part 1. The shocking France reversal. The crucial point here is figuring out exactly how the entire market managed to miss this.
That brings us to Part 2, a massive market misjudgment. Let's look at the flawed narrative that completely blinded the big institutions.
See, even by Thursday, analysts were obsessed with this narrative of cooling risk aversion. They saw a brief easing in global geopolitics and just assumed the franc's appeal as a traditional safe haven asset was totally dead. Plus, strong inflation data in the U.S. was delaying expectations of Fed rate cuts, which drove U.S. bond yields up and widened the interest rate gap between the U.S. and Switzerland. That was the prevailing theory supposedly suppressing the franc. But actually, scratch that. They were looking entirely the wrong way. While everyone was busy staring at U.S. yields, they completely missed the hidden reality of economic data and back-channel deals that were actively fueling the franc's comeback right under their noses.
Moving on to Part 3, 3 crucial turning points. Let's uncover the underlying evidence and the hidden catalyst that sparked this fire.
If we map out the week chronologically, it's actually wild to see how strong underlying data from early in the week was just ignored until Thursday's explosive news forced a massive market correction. It started on Monday with a vital economic pulse check, hit absolute rock bottom on Tuesday, and then violently course-corrected on Thursday, May 21st, when 2 major announcements dropped at the exact same time. Let's break each of these days down, starting with Monday's major hidden clue.
So the clues started on Monday when Switzerland's first quarter GDP grew by a really surprising 0.5% month over month. Against the backdrop of a global economic slowdown, that is incredibly impressive. It didn't just beat the previous quarter's 0.2% growth, it actually beat market expectations of 0.4%. The data showed that both their industrial and service sectors were expanding. Remember, Switzerland relies heavily on exporting high-tech products like pharmaceuticals and precision machinery, so this 0.5% growth proved the fundamental resilience of their economy, and yet the market largely just brushed it off.
Then, fast forward to Thursday, and the central bank steps in. Swiss National Bank President Martin Schlegel delivered this crucial statement, explicitly noting that interest rates should remain stable for a long time and predicting a slight rise in inflation. Think about what this does to the market psychology for a second. It instantly dispelled all those fears of further, deeper rate cuts. It established a firm policy floor for the currency. The central bank clearly signaled that the threshold for returning to negative interest rates is very, very high, putting a strong net right under the franc.
And on that exact same day, another massive economic catalyst emerged. U.S. President Trump confirmed negotiations to slash tariffs on Swiss goods. We are talking about dropping the current 39% tariff all the way down to roughly 15%, with negotiations entering their final stage. For an export-heavy economy like Switzerland, this is a fundamental game-changer. This direct catalyst immediately pushed the euro to a 2-week low against the franc, and honestly, it provided the absolute rocket fuel for that 41-point surge. All right, Part 4, 4 pillars of strength. Now that we've solved the mystery of what happened, let's synthesize the core logic driving this market rally.
These four pillars create the rock-solid foundation for the franc's newfound strength. First, you have the underlying economic fundamentals, driven by that strong 0.5% GDP growth and their highly resilient industrial structure. Second is the direct trade catalyst of U.S. tariffs potentially dropping to 15%, which drastically boosts their export competitiveness. Third, the Swiss National Bank is providing a strict policy floor against negative rates. And fourth, despite what analysts assumed earlier in the week, the franc absolutely retains its enduring safe haven status. The fundamental contradictions of the Middle East conflict remain unresolved, meaning safe haven funds will continue to favor the franc, severely limiting any downside. If you're following this space, this four-part foundation is exactly what you have to respect moving forward.
Which leaves us to our final section, Part 5, What Happens Next? Let's look at future market prospects.
Looking ahead to next week, the overall differentiation pattern in the Forex market is likely to continue, with the US dollar remaining strong. But for the Swiss franc, it's highly likely it'll enter a period of consolidation and volatility as it digests this massive swing. To stay ahead of the next move, you need to track these three specific steps. Step 1. Keep monitoring those unresolved global geopolitical risks, particularly in the Middle East. If risk aversion reignites, the franc will see immediate buying support. Step 2. Track the final implementation of that US-Swiss trade deal. If that 15% tariff reduction gets inked, it gives the franc entirely new upward momentum. And Step 3. Keep a very close eye on the calendar for the Swiss Central Bank's upcoming interest rate decision on June 18th, which is going to provide the ultimate forward guidance.
So to wrap up this explainer, the million-dollar question I leave you with is this. We know the foundation is set, but which of these remaining variables will strike first? Will be a sudden reigniting of geopolitical risks that sends safe haven funds flooding back in, or will a finalization of that 15% tariff cut be the ultimate trigger for the franc's next massive market breakout? Keep your eyes on the data, watch those key dates, and remember, in the foreign exchange market, the underlying reality always eventually wins out over the prevailing theory. Thanks for joining me for this explainer, and keep questioning what you see on the surface.